Alright, listen up. Class is in session. Welcome back to Boss Economics World, the only place that tells you what the numbers really mean while everyone else is busy reading the teleprompter. The date is September 1st, 2025. And the U.S. Bureau of Labor Statistics, our favorite government-sponsored storytellers, just dropped their latest jobs report. The headline? A measly 75,000 jobs added in August. 75,000. Let that sink in. In an economy of over 330 million people, we generated a number of new jobs that wouldn't even fill a large college football stadium. This marks 4 straight months of sub-100,000 payrolls, a losing streak we haven't seen since the world shut down in 2020. The unemployment rate? It just ticked up to 4.3%, a number we haven't seen since late 2021. The mainstream media will spin this as a softening or a cooling. Let's call it what it is: the economic engine is sputtering, running on fumes, and the check engine light has been on for months. This isn't a soft landing. This is a controlled glide towards the tarmac with one engine on fire. So today, we're going to dissect this mess. We're going from the surface level symptom, this pathetic jobs number, down to the disease festering in the bones of the American economy. Buckle up. First, let's look past the headline. When you pop the hood on this 75,000 number, the picture gets even grimmer. The real story isn't just that we're not creating jobs, it's about the people who are simply giving up. The report mentions a decline in the participation rate. This is a deceptively sterile phrase. What it really means is that more and more people are dropping out of the labor force entirely. They aren't counted as unemployed because they've stopped looking for a job. This is the I give up indicator. According to our deep dive, the labor force participation rate for prime-age workers, 25 to 54, just fell by another 0.2% to 82.8%, wiping out nearly a year of post-pandemic gains. So, the 4.3% unemployment rate is artificially low. The real number of people not working is significantly higher. It's a statistical magic trick to make the patient look less sick than they are. And for those who do have jobs? Wage growth came in at a paltry 0.2% for the month, or 3.8% year over year. Sounds okay, right? Wrong. The latest CPI reading is stubbornly hovering around 3.5%. That means your real wage growth is a pathetic 0.3%. After taxes, you're basically losing money by going to work every day. Congratulations, you got a pay cut in slow motion, and the government calls it a resilient labor market. This jobs report lands like a grenade in the middle of the Federal Reserve's boardroom. They are trapped in a cage of their own making, and now they have to fight their way out. This is the classic stagflation-like dilemma, a term you won't hear from Chairman Powell, but it's exactly what this is: stagnating growth combined with sticky, persistent inflation. In one corner, you have the doves, like Governor Christopher Waller. They see the abysmal hiring, the stalling wage growth, the declining job openings, which we'll see fall again to a 3-year low this Wednesday, and they're screaming, cut the rates. The economy is choking. They believe that the inflation fight is mostly won and the real danger now is tipping the whole thing into a full-blown recession. In the other corner, you have the hawks. They're looking at inflation that's gradually increasing, and they're haunted by the ghost of the transitory fiasco of 2021 to 2022. They remember getting laughed out of the room for claiming inflation would just disappear. They're terrified of cutting rates too soon, only to see inflation roar back to 5% or 6%, forcing them to hike rates even higher later and cause an even worse crash. Their credibility is on the line. So what does the Fed do? They're paralyzed. They're walking a tightrope on a unicycle in a hurricane. This week, we'll get the beige book, the Fed's little diary of economic feelings, which will be filled with anecdotes from business owners saying, yeah, things are slowing down, and costs are still high. It will tell us what we already know: the Fed is stuck between a rock and a hard place, and they'll likely choose to do nothing in September, kicking the can down a very steep hill. Now we get to the real cause. Why are companies so hesitant to hire? Why are costs so high? The Fed's rate hikes are part of the story, but they're not the whole story. The root of this malaise is a chaotic, self-defeating trade policy that is poisoning the well of American business. President Trump's grand strategy is to use tariffs to reverse trade imbalances and spur domestic output. It's a great soundbite. The reality? It's economic vandalism disguised as patriotism. Let's look at the data. The stated goal is to reduce the trade deficit. Yet, the advance report for July showed the goods trade deficit widened by a staggering 8% to over $105 billion for the month. $105 billion. We are winning the trade war by posting some of the worst trade deficits in history. How? Because businesses rushed to import goods before the threatened new round of tariffs kicked in. This is an economic strategy, it's a panic buy at the global supermarket. These tariffs are sold as a levy on China or Europe. False. A tariff is a tax, and it's paid by American importers, who then pass that cost directly on to American consumers and businesses. Data from the National Bureau of Economic Research and the Federal Reserve itself has consistently shown that nearly 100% of the cost of these tariffs is borne by the U.S. economy. So when companies are paying 25% more for steel, 20% more for components from Asia, and facing retaliatory tariffs on their exports, what do? They don't magically build a new factory in Ohio. No, they do two things. 1. They raise prices, which fuels the inflation the Fed is trying to fight. 2. They cut costs. And what's the biggest, easiest, and fastest cost for a company to cut? Labor. They freeze hiring. They lay people off. They cancel expansion plans. The uncertainty is the real killer. Who is going to commit to a 10-year, billion-dollar investment in a new plant when the entire global supply chain could be upended by a 3 a.m. tweet? The recent federal appeals court ruling that found the tariffs illegal but let them stay in place for now only adds to the chaos. It's a flashing neon sign above the U.S. economy that says, unreliable. Invest at your own risk. This isn't just an American problem. This is a story of global contagion, and we are patient zero. Look at our friendly neighbor, Canada. Their latest GDP figures showed the economy just contracted for the first time in nearly 2 years. Why? A massive hit from these very same trade tensions. When the U.S. economy gets a cold from protectionism, Canada, with its deep economic integration, gets a severe case of pneumonia. Their own jobs report this week is expected to be just as grim as ours. Look across the pond. The Eurozone is wrestling with its own sticky inflation, and their manufacturing PMIs have been in contraction territory for over a year, in no small part because global trade is seizing up. Look to Asia, where the manufacturing hubs that power the world are seeing new export orders evaporate. What we are witnessing is the painful, messy unwinding of globalization. The intricate, efficient, and deflationary system of global supply chains that gave us 3 decades of cheap goods and stable prices is being dismantled with a sledgehammer. The result is a world that is less efficient, more expensive, and far more volatile. So let's bring it all home. This morning's garbage jobs report isn't an anomaly. It is the logical, predictable, and inevitable consequence of a two-front war being waged on the American economy. From one side, you have a Federal Reserve that slammed the brakes so hard they're at risk of sending the economy through the windshield. From the other, you have an administration waging a trade war with a confetti cannon, creating maximum chaos for minimum gain, fueling the very inflation the Fed is fighting. The 75,000 jobs number is just the fever. The disease is a toxic cocktail of confused monetary policy and incoherent trade policy. So, what happens next? The Fed will likely stay frozen in fear. The administration will likely double down, claiming the pain is temporary and victory is just around the corner. And in the middle, the American worker and investor are left holding the bag, watching their job security vanish and their purchasing power evaporate. Don't watch the headlines. Watch the underlying currents. The data is clear, the slowdown is here, it's accelerating, and it was engineered right here in Washington, D.C. Class dismissed.